Welcome to the MIT Social Entrepreneurship Alumni Group webinar, The ABCs of Investing in Climate Change. I am Sayuri Sharper, President of SEED and moderator of today's conversation. Today, we're privileged to have three distinguished guests to guide us on how an individual investor can go about using their investment to affect positive outcomes relating to climate change. Climate change is undoubtedly the biggest threat modern humans have ever faced. It is a crisis multiplier that affects every aspect of human life, including food security, natural resources, and habitable land. We as entrepreneurs and investors can work together to help mitigate negative effects of climate change. Our first speaker, Jesse Simmons, Director of Research and Advisory at CapShift, will set the stage of our discussion by introducing us to the type of solutions and investment strategies that are available. Our second speaker, Dario Pazios, Director of Investment Research at Tonic, will address climate change in investments in private markets. And our last speaker, Jennifer McFarland, Board Director and Advisor to clean tech and social impact companies, will address climate change investments in public market. Before we get started, I'd like to say a few words about MIT SEED. SEED is organized under MIT Alumni Association. Our mission is to bring together MIT alum and like-minded people to co-create a better world through social entrepreneurship and impact investing. Terminology is important. What do we mean by social entrepreneurship? Any organization that is addressing unmet social needs or environmental problems through a market-driven approach. And impact investments are investments made with intent to contribute measurable positive social or environmental impact. If any of you are not a SEED member yet, I'd like to invite you to join us. In addition to webinars, we also host live pitch sessions, mentoring programs, and other networking events to connect our members to each other. To join, please go to mit-seed.mn.co. Now let me introduce you to our first speaker. Our first speaker is Jesse Simmons. Jesse helps lead the investment research team and advisory practice at CapShift. Jesse previously served as senior investment analyst and impact advisor at Align Impact, where he managed due diligence on private investments and helped clients discover and act on these opportunities. Jesse began his career at the World Bank and subsequently worked at Dalberg Global Development Advisors, a mission-driven consulting firm. Jesse has a Master of International Business from the Fletcher School of Tufts University. Jesse?
Thank you so much. Very nice to be with you all. I also had the pleasure of cross-registering for one class at MIT Sloan while I was at the Fletcher School. So kindred spirits, to be sure. Very nice to be with you all today. Can you see my screen okay?
Yes.
Great. Okay, so going to kick off with some high-level comments on the ABCs of climate investing and some of the motivations and strategies that different families might bring to investing in the climate and climate change and climate solutions in particular. So to get us started, at CapShift, we work with many different types of asset holders, both families and advisors and other intermediaries working to grow impact investing with a real focus on climate. And in working with these different investors, we but we realized that there were three main things that were bringing prospective climate-focused investors to the table in the first place. And these were we broke into three different motivations for why might I consider climate-focused investing. The first is climate change mitigation. So bringing a goal of slowing the pace of climate change. This is often what we think of first when we think of climate-focused investing, really focused on reducing emissions, increasing the amount of sinks, taking carbon out of the atmosphere, and really sort of limiting and slowing the impact of climate change as sort of the first focus area and goal that one might have for approaching climate-focused investing. The second piece is resiliency, also talked about as climate adaptation. And so climate change is here, it's real, we're feeling the effects, vulnerable communities are feeling the effects in particular. And so many investors are also looking for, well, how do I help remediate the effects of climate change that's already happening, and empowering vulnerable communities to protect themselves and to be resilient, truly resilient to these types of effects of climate change. And so we broke this particular, you can think of two particular ways of going about resiliency, both community-focused solutions as well as larger scale resilient infrastructure, all positioning our communities and societies and cities to be able to deal with and be resilient to the effects of climate change. Finally, there's the investment portfolio. So we are talking about investing in climate solutions. Many families, advisors, and others are also looking to protect against climate risks in their portfolio and ensure that they have a well-diversified portfolio ready to both benefit from the changes and shifts that we see as we move to a lower carbon economy, and avoid some of the risks associated with climate investments in things that have high exposure to climate risks. And so this final piece is really the motivation of making sure and for those investors that are putting financial return and performance as an equal goal in their portfolios, that this can be done without that sort of sacrifice. And so by taking climate change seriously and thinking and approaching investing from a climate-focused perspective, this can also reduce long-term volatility of a portfolio, reduce risk in some cases, and potentially add exposure to industries that might be benefiting. Of course, these are immensely overlapping issue areas. So this Venn diagram is attempting to show some examples of those investment types that exist across these different sort of spectrums or across these different areas. And so you can think of agriculture, for example, a topic that comes up frequently, has major overlaps with all three of these areas. Resilient agriculture is a big deal for helping improve resiliency in communities that are set to suffer from desertification, decreasing soil health, and inability to productively grow and produce food. This is also a big deal for mitigation. Agriculture is a major driver of climate change itself, particularly the animal farming industry, and many different ways to sort of invest and take advantage of and catalyze this mitigation and lower carbon forms of feeding ourselves. And then finally, alpha. You could have following the trajectory of Beyond Meat is an example that got a lot of exposure of investors who were at the forefront of investing in these plant-based alternatives or innovation in the agriculture space, who benefited financially from this, as well as these industries have come to gain greater adoption and be more of a presence in our lives, in our grocery stores and the restaurants we go to. Being at the forefront of that can be a financially attractive thing to do from a portfolio perspective. So many different overlaps here as we think about these three driving motivations and many different subsectors that they fit into. I'll take just a couple minutes to go into some of the examples of a little bit more depth in each of these industries. And this is pulled directly from our ABCs of Climate Investing report, which is available on Capshift's website. So if interested in going deeper, it's all there publicly. So in the mitigation space, we break this opportunity set into two distinct sort of sets of solutions: proven solutions and emerging solutions. Many folks are familiar with Project Drawdown, a seminal piece and ongoing analysis looking at all of the existing technologies and the ways that we could scale them and grow them to get to the point of drawdown, where CO2 and equivalents, atmospheric CO2 and equivalents, have reached their peak and start to decrease. Renewable energy generation, energy efficiency, electric vehicles, biofuels, their sustainable agriculture in many forms. There are no shortage of examples of things that we see in our economy already, proven solutions that the scaling of which will have major climate impact. And so you can think from an investment perspective, this has a different flavor as well. You're looking at often looking at investment opportunities with a lower risk profile, not directly driving innovation or new products and strategies, but helping to sort of grow the scale of these solutions that have proven and demonstrated impact. Also looking at a different risk profile from the impact side. Whereas innovative technologies like in an emerging solutions category might have potential to not work out. You know, in venture capital portfolios where we see a lot of the innovative technologies get their funding, there's far from a perfect hit rate of companies that end up scaling. So from an impact risk standpoint, how likely is this going to have the impact that we hope it does? Different profile from proven to emerging solutions. That said, there's much need for new technologies and new capabilities that are going to allow us to live in a different space from a climate perspective. Just this morning, there was news on major progress in nuclear fusion, which is very exciting, an example of one of many different sort of technologies that the innovation of which and the development of which will cause major changes and drive major progress in the fight against climate change. And so emerging solutions are for those investors that are participating in the genesis and development of those solutions before they're proven and at scale and ready to really scale. And so here you see a different financial profile, a different risk profile, oftentimes in the venture space, as well as the private debt space. And you're seeing different types of financial profiles as well. So some catalytic funds that are saying we are going to expressly take outsized risk for this, and some that are saying we can do this in a market rate way. We see the presence of both of those in the field, and many different the growth of the venture capital funding the clean tech space over the past couple of years has been immense. So lots of opportunities there as well. Second, moving to resiliency, looking at community solutions and resilient infrastructure, as I mentioned. Here on the community solution side, we're seeing opportunities all over the world. So smallholder agriculture, off-grid renewable energy, storm and flood resistant affordable housing, all examples of how we're helping and impact investors are helping drive success for low-income communities with access to these services and able to sort of best weather these storms that they're experiencing already. And then second, resilient infrastructure. Here we're talking larger scale installations of smart electric grids, maybe at the municipal level or larger, risk modeling, supply chain analytics, the big picture things that will make our supply chains and cities and communities resilient to the impacts of climate change. And then finally, alpha. The two examples here are typically risk mitigation, upside capture. I won't spend a ton of time on this slide, but to say there's been a lot of research done on low carbon intensity portfolios and the ways that by limiting the carbon intensity of supply chains and companies within a portfolio. As the price of carbon increases, which we've seen happen over time, those portfolio companies with a higher carbon intensity are more vulnerable to the financial repercussions of that growing price of carbon. And so limiting the carbon intensity of a portfolio as a financial strategy of risk mitigation is one that we've seen many managers and many advisors employ. And then secondly, upside capture. So this is most of the world's GDP has committed to some form of net zero. Many of the largest companies in the world have committed to being part of this lower carbon transition. In that process, we will see growth of lower carbon industries. And so electric vehicle infrastructure is a popular example of what was once something very novel and new has become much more mainstream, captured much more capital, and rewarded some of those investors who are at the front end of that, investing in that, the growth of the electric vehicle space. And we expect to see that with many other sort of low carbon industries and companies that are helping sort of drive this transition and benefiting from its effects. There are three different strategies. How do you do it? How do you integrate it? This is very high level, but for prospective investors, really focusing on this cyclical part of implementing a climate-focused strategy. So starting with the goals, which we just outlined, what does success look like for any individual investor? Building a strategy that brings out the asset classes and investment structures that hit those impact, risk, liquidity, return goals, implementing that portfolio over time. And then that last piece of really making sure that we're creating feedback loops, both on the financial side and monitoring closely, and also on the impact side. Are the key performance indicators and outcomes that we hope to be driving, are they happening? Are we seeing that in the space? And then the last slide that I'll touch on very briefly is every individual investor, climate-focused investor is different and has different types of requirements. And one great benefit that we're seeing of the richness and diversity of climate-focused investment opportunities is you can really solve for many different types of goals. And so we've seen clients that have come and said, I want to protect my portfolio from market and climate risks, and seen those portfolios tilt much more towards real asset investments, for example, in utility scale clean energy or sustainable agriculture or sustainable forestry and timber, all examples of investments that have downside protection from real asset profile, some sustainable income streams and the like, and sort of protecting against some climate focused and financial risk factors, as well as maybe circular economy, private equity, later stage equity investments, and public bonds focused on climate solutions. And that will lead to a different liquidity and risk profile at the portfolio level. Subsequently, also with maximizing impact on slowing climate change, with catalytic investments, which we're seeing a ton of. So pre-seed climate technologies going before the venture capital funds, pre-construction clean energy infrastructure development. We see some really great innovation of investors that are able to say, I will put my capital before it's proven, before the larger commercial or municipal capital or national capital can follow, and really seed the things that will be ultimately transformative. And then finally, sort of mirroring what a traditional investment portfolio might look like, but finding opportunities in each asset class that someone already has exposure to that's able to drive meaningful climate impact without sort of dramatically changing the underlying financial components. So I'll pause there. Happy to go deeper on sort of the wealth of climate-focused investment opportunities, and happy to pass off to my colleagues who will go a little deeper.
Thank you so much, Jesse. I kind of forgot to say this at the beginning, but everybody that's listening in, please feel free to put your questions in the Q&A using the Q&A function of Zoom. We will not get to these questions until the end of the formal presentations, but we want to make sure that when a question comes up that you put them in. And so we can respond to them as much as possible at the end of the presentation during the question and answer period. Now I'd like to introduce Dario. Dario leads the investment research and analysis team at Tonic that assists members to shift their investment portfolio to 100% impact. Prior to Tonic, Dario worked at Ernst & Young as a financial auditor for banks and investment funds. He holds a Bachelor of Science and a Master of Science in Management from Bocconi University. He also holds a Master of Social Entrepreneurship from the Holt International Business School in San Francisco. Dario.
Thank you very much, Sayuri, for the introduction, and it's a pleasure to be with all of you today. Today I'll cover private investment in climate change solutions. I will start with a very brief introduction to Tonic. We are a global community of over 500 high net wealth individual, family office, and foundation investors who are seeking deeper impact in their investments and in their lives. We serve investors in about 25 countries and an estimated wealth of about 25 billion. We are not for profit, so we're not an investment advisor, and we don't recommend investments, but we rather support with a global community of practice investors. We identify and share investment opportunities that our members can evaluate, and that's actually my role: education, knowledge and research, and impact measurement. So in order to cover private investments in climate solutions, I thought there are two main messages that I would like to focus on today. The first is the role that private investment play in climate solutions. And in my view, the role that private capital plays is really to help the risk and catalyze innovation at the very early stages, and then help it scale. And included this chart from the venture capital cycle that shows how companies in the early stages, at idea and startup, when cash flows are negative and the risk of failure is very high, really need help of private investors, such as seed investors and angel investors that can come in even with small checks, but that can help companies validate the technology, the business model, product market fit, and then at the later stage of development and growth, help scale. And this time, especially climate innovation tends to require heavier investments, especially when they are capital intensive innovation. So private investments really are needed to bring these solutions to scale, and then maybe on the public markets. And the second message that I'd like to share is the breadth of investment opportunities. So Jesse mentioned before, Project Drawdown is this global non-profit organization that is focused on scientific research on climate change. And I like to cite them because they kind of shift the problem by looking at solutions. What are the solutions that we can focus on to address climate change? And in this pie chart that you see here, they have ranked different solutions for their potential emissions, for the potential reduction in emissions in CO2 equivalents. So as you can see here, there are some usual suspects, such as energy production. You can see wind turbines and solar farms. These are the yellow slices of the chart. But there are other areas which, sometimes are a bit overlooked, but they are very impactful. For example, avoiding leakages of refrigeration gases, reduce food waste and plant-rich diet, tropical forest for its potential to sequester carbon from the atmosphere, but also providing access to education for girls in emerging markets, and family planning has shown to help families with better consumption decision, and also fertility rates. So there are really a breadth of investment opportunities. And in the next couple of slides, I would like to share some examples of investments that address these solutions. Before doing so, very brief disclaimer, the companies and funds that I'm presenting are only included for educational purposes, and this doesn't constitute investment advice. and all the examples rely on publicly available information. And if you would like to consider investment, you should consult with your own financial or tax advisor. Starting with energy. So energy production gives rise to about 25% of the heat trapping emissions globally, yet almost 1 billion people lack access to electricity. So some investment verticals that we see as major ones include definitely energy generation, but also access to clean energy for people that are currently excluded. A fund that does so, it's SunFunder. SunFunder leverages blended finance fund. Blended finance means that the funds combine both philanthropic capital and commercial capital in order to de-risk solutions. And SunFunder invests in distributed solar and other renewable energy projects in emerging markets, mainly in sub-Saharan Africa and in South Asia. And their focus is on providing access to energy for millions of people and mitigate CO2 emissions by displacing fossil fuels and diesel. There are also another important investment vertical is technology and infrastructure. I included 2 funds here. The first is Prime Impact Fund by the Prime Coalition. And this is another blended finance vehicle that is designed to invest in very high risk and high reward technology ventures at the earliest stages. Given the risk of failure, this is why they design a blended finance model so that philanthropic capital can absorb potential losses. What is interesting about Prime is that they use a fact-based methodology to assess every technology for its potential on reducing emissions, but also the focus on hard technologies that are more capital intensive, they're not consumer facing, and so sometimes they're more difficult to finance. This includes batteries, industrial processes, or engineered carbon sequestrations. And another fund, it's Full Cycle, and it's an infrastructure fund. They invest in technology companies and their related infrastructure projects. And the interesting thesis of Full Cycle is to focus on abating short-lived climate pollutants that have a disproportionate warming effect in the first 20 years of emission. An example of this is refrigeration gases that we saw before in the project drawdown slide, but also methane. Another important set of solutions is related to agriculture, and agriculture and forestry combined generate about 24% of the greenhouse gases emissions. And one of the investment vertical that we are seeing gaining more and more traction is regenerative agriculture, which is a set of agricultural practices that are meant to store carbon from the atmosphere into the soil. They integrate like no-tilling practices, organic farming, biodiversity inclusion. And an example of regenerative agriculture funds, it's Replant Capital that finances large-scale farmers who make the transition from conventional practices into regenerative agriculture. Another major investment area is food waste. And food waste is a huge contributor to emissions, both at the production stage of food that is later not consumed, but also when food decomposes and it emits gases such as methane. A company that is addressing this is called Surplus. It's a German chain of supermarkets that brings food waste back into circulation by offering it for sale at online and physical shops. This is either food that is near the expiration date or food that is just past the best buy date, when it's still safe to eat. Maybe the taste cannot be guaranteed, but it's still safe to eat. And a third area which is growing very fast is alternative proteins, especially alternative proteins to animal farmings. This includes plant-based proteins, cell-based agriculture, so cultivated meat, and precision fermentation, which is a set of techniques that are able to program microorganisms such as fungi and bacteria to produce certain proteins. And a fund that is focused on this vertical, it's AgFunder and the New Carnivore Fund. Next, I'd like to focus on 2 major natural carbon sinks. So these are ecosystems that absorb carbon from the atmosphere. The major ones are ocean and coastal areas, as well as forest and natural landscapes. One of the funds focused on ocean that we have seen is the Blue Revolution Fund, which is a partnership between Hatch Blue and the Nature Conservancy. And what they do is to invest in regenerative aquaculture farms. These are, for example, seaweed farms or mollusk and bivalve farms that have the potential to sequester carbon from the atmosphere or also produce proteins very efficiently. And in terms of forestry, a strategy that we have seen is by EcoTrust Forest Management, which buys conventional forests and they use tools such as conservation easements. These are grants given by the government to preserve the forest, carbon offsets. So by increasing the density of trees and better managing the forest, they increase the carbon sequestration potential and can sell carbon credits, tax credits, and other recreational permits that can monetize the value of the trees without harvesting the logs for lumber. So this is really a shift in the mindset. It's about valuing the forest for where it stays, for keeping the trees in place, as opposed to harvesting them. And another area which is a very large contributor to emissions is industry and manufacturing. It's responsible for about 21% of all heat trapping emissions. And major contributors include cement, iron and steel, but also plastic, aluminum, fertilizers. There are two investment verticals that I included here. One is green building, and an example of that is Green Canopy. This is a fund that builds sustainable buildings, including net zero energy homes. These are fully like self-sufficient homes when it comes to energy, and they make efficient use of space by reducing urban sprawl, and also adopt building techniques that use better materials and don't burden landfills. And another major investment area is circular economy. I bet most of you will be familiar with circular economy. It's a way of thinking about production, which thinks about the life cycle of products by minimizing waste, reusing, and maximizing the lifespan of products. A fund that invests in this vertical is Regeneration VC, and they invest in companies that reimagine the material life cycle of products by designing and producing with a zero waste life cycle, and that convert waste into valuable materials. And the last area that I'd like to cover is water and sanitation. So as Jesse was mentioning before, the pressure of climate change require us to adapt to the effects of global warming. And one of the area where our society will be mostly stressed in the future is water availability. And it's important to invest in water conservation, but also access to water, clean water and sanitation. On the water conservation side, I included Pure Terra Ventures. This is a fund that invests in technologies that address the increasing need for water, such as water circularity systems, water quality treatment, such as desalinization, and efficiency of water, and also access to clean water. And an example here is the Global Access Fund by Water Equity that invests in financial institutions and companies in emerging markets that provide access to safe water, but also sanitation to low-income consumers. So I hope that this overview gave you an idea of the potential to advance climate solutions through private investments, and give you some maybe possible investment ideas if you are an investor, or areas that you could focus on if you're an entrepreneur. And with that, Sayuri, I'll pass it back to you.
Thank you, Dario. We have some questions that is coming in regarding whether or not these presentation slides will be available. And the answer is yes. And everybody that is registered or attending this webinar will get the slides sent from the MIT Alumni Association. And you can also join the MIT SEEG group, and we will have that posted there as well. So our last speaker is Jennifer McFarland. She's a dear friend, co-investor, and co-loan committee member at MC Social Capital. Jennifer is a seasoned CFO of an Australian public company and several venture-backed companies with expertise in successful scaling diverse hardware technologies globally. In her C-suite roles, she has focused on developing and implementing strategic plans and innovative business models, securing strategic partnerships, and implementing systems to support rapid global growth. Jennifer holds an MBA from Stanford University and Bachelor of Science and Law from University of New South Wales. Jennifer is going to talk about the public market opportunities beyond the private market for climate change investing. Jennifer?
Great to be here, Sayuri. Thank you very much. I'm going to share slides. Hopefully this works pretty well. Excellent. So I have the privilege of talking about public market investing, and I'll touch on 3 topics. Do public markets matter? Making a climate impact, and some fund and ETF examples. Does that work?
Yes, that looks great.
Excellent. And
Perfect.
super. So I'll just move on to 1, do public markets matter? First of all, it matters more than you think. It is generally your largest investment allocation. And as we know, all companies, all investments have a climate impact. So think about it. Think about how you can allocate to companies making a better impact. And there's actually 2 dimensions to the impact. One is the company itself or the investment, and the other is what you can do as an investor. And I will go over that in the next slide. The second thing is that the opportunities have increased terrifically over the last 2 and 3 years. So you can actually put a climate lens on a broad portion of your public portfolio. It covers equities, bonds, real estate assets, or like real estate assets, commodities, real estate, and infrastructure. So there's a wide choice to choose from if you're looking to add a climate lens. So making climate impact. First, there are 2 dimensions. One, as I mentioned, is the impact of the company that you're investing in itself. You can choose, as has been mentioned before, let's avoid harm. Let's avoid investing in any fossil fuel companies. That's a great start. If you want to make a larger impact, you can invest in climate leaders or solution providers. Climate leaders are those companies that have low or the lowest greenhouse gas intensity relative to their peers. They really are the industry leaders in addressing climate change. The solution providers, on the other side, are those companies that are developing climate technologies. And you've heard quite a bit about that from Dario and Jesse. But you also have an impact in terms of your own actions. One is purely by moving funds from one investment to another, you create a signaling impact. You can increase that impact if you actually move your funds to into a fund or ETF that's new, and you can help grow it. And finally, and the largest impact is voting, which is exciting. So let me move on to the climate impact, and just to dive on the company side, just to dive down into more detail. As I mentioned, there's climate leaders, and what they do is you look at how are they operating. 2 examples are Microsoft and even Alcoa. Even a company that produces aluminum can be an industry leader. And the metrics that you look at or tend to be looked at are, what is their greenhouse gas intensity as % of sales? And are they making commitments to net zero greenhouse gas targets on a science-based approach? The other approach on the climate solutions is the what products and services, and key metrics that are looked at is what % are green revenues, or and in terms of how green are those green revenues, how much do those products and services actually reduce greenhouse gases? 2 examples are obvious, Tesla and SunPower. Now on to the impact you have as an investor. You can vote against climate laggards. This is becoming increasingly popular. There's a tsunami of institutional activism focused on this, as you can see in the graph. This is the graph of US climate-related shareholder proposals from 2018 to 2021. As you can tell, in the last 3 years, there's been an increasing number of proposals focused on climate, as well as an increasing positive vote supporting those proposals. Last year was a watershed year. The activist firm Engine No. 1, which had 0.05% shareholding in Exxon, unseated 3 Exxon board members. So what can you do? You vote your own shares if you have them. And if you're looking for guides, there's 2 guides. One is a proxy preview and As You Sow. You can invest with fund managers that have a history and tradition of being activist. And these are 4 or 5 below: Trillium, Green Century, Calvert, Putnam, and Pax. And then you can also support NGOs that are active in this area, that aggregate institutional investor proxy voting to support climate resolutions, and As You Sow, which also does something similar. Now, let me move on to a few examples of funds and ETFs. I'm going to first focus on climate leaders and provide some overall perspectives, so you can take this into account as you look at funds yourself. So as I've mentioned, climate leaders, things you look at is they have lower greenhouse gas per dollar of revenues than their peers. Many are fossil fuel free, but not all. And you have to look at more sophisticatedly, because some actually own utilities that are fairly strong in renewable energy, but they have a little bit of gas as well. But they're moving towards more renewable energy. And some of these funds have additional ESG and/or product criteria. The portfolio composition of these funds and ETFs tend to be along standard in industry allocation. So the advantage is they can match very closely or at or above benchmarks. A few may be smaller cap, however. So the considerations are: 1, there's lots of ETF choices with low fees. And there are a number of activist fund or ETFs that tend to have higher fees. And I'll just go on to this in the next page. So these are the examples. The top 2 are ETHO and SUSL, which are focused in the US market. The bottom 2, the next 2 are global. ETHO represents the more activist, the more impactful fund. You can see it has low tons of greenhouse gas per dollar of revenues at 51. If you look at the bottom, that compares to 136 for the S&P, so about a third. It is strictly fossil fuels, and they are active in voting. The one underneath that, SUSL, is purely focused on low carbon intensity. It has not quite fossil fuels, it has no reserves, and it is not active in investor in voting. The next 2 funds or ETFs, PORTX and LOWC, are global, and they represent, again, the 2 alternatives. PORTX is more activist, has a higher fee. LOWC is more passive, very simple, and has a lower fee. Finally, I actually wanted to mention a new ETF, VOTE, which follows the S&P exactly. It was started by Engine No. 1. It has this, holds the S&P. Its sole purpose is to focus on voting. Okay, well, let me move to the next slide. Now I'm going to talk to you about the solution ETFs and funds that are solution providers and provide some more perspectives. Now, first of all, this is a trickier area to invest in. It takes a little bit more attention. So the typical criteria, that I put the word narrow, which means the funds look for investments in clean energy, environment, electric vehicles, batteries, some commodities, and infrastructure. Some are slightly wider, and they'll look at investments in water, services, ag, and related services. The portfolio composition, however, tends to be more limited. These sectors typically have many companies in the industrial and material sectors. And I'll have to tell you, these sectors traditionally have been the slower performers within the S&P overall. The companies are smaller, they have higher growth. The reality is also very few of them are just US focused. So you're actually looking at a global portfolio versus a US portfolio. And you should look at their unique risks, political and limited universe. So as you'll see in the graph on the right, which is very, very astounding, is had you invested in the S&P Global Clean Tech Index back in the beginning, just before COVID, you would have done fantastically. You would be up 80% versus the global index of 33%. Had you invested at the beginning or the beginning of 2021, you would have done terribly. And part of what this reflects is the fact that there's only a limited universe of companies in these sectors, and the institutional flow can overpower valuation. So just this area just needs to be done astutely. You can reduce volatility by looking at funds that have a slightly wider criteria and focused on funds that can be a bit more active than passive. So I'll just go on to some examples here, and I won't again go into detail because you'll have this yourself. So the first one is these tend to be funds, as you can tell by the 5 ticker symbols. The first one is the only one that's really focused on the US. The rest are global. The first 3 have sort of the broader definition of climate, broader climate or climate and health. You can see that they're relative to their benchmarks have actually performed well. The one ETF is GRID, which is really focused on, which is more narrow focused on what's happening in the electrical grid market. And then finally, you've got renewable utilities, which has done extremely well. But as you can tell with Carrick's, that last year was a horrible year with negative returns. Although had you invested mid-2020, you would have been fine. There are many, many ETFs in this sector. I've got listed a few right at the bottom. It's like QCLN, TAN, FAN, Drive, Hale, Veggie. You can go on and on, but I recommend looking firstly at those with more breadth. Finally, there are also funds and ETFs in bonds and real assets. I will just sort of say, in terms of bonds, this is an increasing interest rate environment. And so it is perhaps not the best time to focus on bonds. It may be more interesting to look at real assets. There is a sustainable real estate REIT, VSRGX. There are commodity ETFs, REMX, which refers to real sort of rare earth minerals, and BATT, which has a large allocation to lithium mining and uranium. Now, just recognize that commodities are tremendously volatile. Many of the investments are actually in China or overseas. A new asset class is actually carbon credits. These are the two ETFs that invest in carbon credits. They have done extremely well, but recognize also that carbon credits, there's a concept of an upside limit, and they may be getting closer to that right now. I'll mention there's there's an increasing number of infrastructure funds, but they do have high percentage of oil and gas. And with that, I will say thank you for listening, and I'll pass it back to Sayuri and the MIT team.
Thank you very much, Jennifer. So now is our Q&A time. For those of you who have questions, please use the Q&A button and submit them, and we will get to as many of them as we can. So the first question is from Matthias Witt. The question is, do you have any experience with voluntary profit reinvestment of investors? That is, investors investing a percentage of financial returns of their portfolio into mitigation or adaptation programs. I guess I'll give this question to Jesse. do you?
Sure. Sure. There's many different ways that we've seen sort of donation of proceeds from climate-focused investing portfolios. There's a family of funds based in San Francisco, I believe, called Legacy, that is all about donating the proceeds of the LPs 100% to their different charities of interest. And different investors and donors have come up with different schemes to allocate capital and returns from their investments into charitable purposes. I think the important thing to be clear on with climate-focused investing is this is in supplement to granting and philanthropy, which plays an important role. There are many areas that investment can't yet reach at a deep level where philanthropic capital is just necessary. And climate-focused investing, I think at its best, is awakening the assets that have been invested, the trillions of dollars that have been invested, but not contributing to the same thing that a family might be granting towards. And oftentimes, in fact, as Jennifer mentioned, there's impact in the investments wherever they are, and we should know about it. And so many families that we work with realize that their investment portfolios are actually working in contradiction to their philanthropic goals, and that remedying that is the first step, and then activating it for positive impact is the next.
Thank you. Okay, the next question from Natalie Lorenz, and she's asking, how would a Series A MIT Technologies spin-off company get connected to investors and/or funds from the perspective of the speakers today? Let me give this to Dario first.
Yeah, I think that many of the funds that we covered, or at least I covered, we try to convey the investment thesis of these funds. So I think it's a matter of researching the alignment of the company with the investment thesis of the funds, and trying to apply for funding from those. We are seeing a growing trend towards specialization of funds to be very laser focused on specific investment verticals and themes, because they can provide more value with coaching and support to the portfolio companies. So I think it's a matter of researching and creating a network and reaching out to the right investment funds. For our network, for companies, we typically work with companies that come referred by an existing member of Tonic. So we will need like a Tonic member to be an investor to refer potentially a company, but different networks work in different ways. There is another one that I know of, like Creo. It's a climate investment network. I think they have different criteria, or Investor Circle. So I think it's really a matter of researching alignment and trying to find the right company or fund to apply for.
Thanks, Dario. Next question is from Lenora Suki. And her question is, have all the investment mentioned by Dario being funded via a combination of grants, catalytic capital, and finance first impact investment? Dario.
Yeah, so that's a great question. So not all of them. What we have seen is that blended finance, so this combination of philanthropic funding with commercial capital and catalytic capital, it's especially needed when risks are very high. So there are some investment theses, such as some fund that was investing in emerging markets, and there might be losses at the portfolio level. They, for example, use a combination. Prime fund, they invest in very high risk ventures, which are often neglected by their funders. The water equity fund or Replant Capital, they all take high risks, and so this blended finance supports that. But there are other investment theses, such as circular economy, green building, climate infrastructure. They don't need catalytic capital because they are proven, and commercial capital it's already flowing into these funds or companies. So they are ready for impact investments, commercial impact investments, and they don't need any type of catalytic capital or philanthropic capital.
Great. And the next question is again from Aurora, but I think there's an interesting one. Thank you for the emphasis on voting. How US-centric is that strategy? I have the impression that shareholder rights outside the US, even in developed markets, make voting and engagement difficult, but not sure. I think this is for Jennifer.
Super. Yes, excellent question. And absolutely right. It has become more prominent in the US than overseas. However, there are institutions, the largest institutional investors are working together around the world. So basically there is this organization series that has like a membership of institutional investors with like 50 trillion asset under management. This includes a number of large investors within Asia, as well as in Europe. And each of them work together within industries and companies in their own industry, in their own geographic region. I'll say, so the institutional effort is definitely global. I'll also say that in terms of the US, it needs a little bit more nudging than some of the companies within Europe. So I'm glad it's here.
Great. Next question is from Farah Karim. And her question is, how do you match this climate logic to SDGs? And do you take into account UN or IRIS metrics on impact? I'll give this question to Jesse.
Sure, great question. So we think of SDGs as the big picture for big picture goals that we might be pointing towards, and as climate-focused investing as a set of different tools for achieving many of those goals. So climate action, life on land, life on water, sustainable cities, there's no shortage of SDGs. Probably most of them have some overlap with climate investing. And part of what climate-focused investing we're trying to do is activate a new set of capital to achieve these goals that were really set out for governments and philanthropists and public capital to achieve, and saying investment capital has a role to play here. So there's trillions of dollars invested. How can we activate that to contribute to those very SDGs? Those can be sort of useful guiding forces, but connected to the next question, not always metrics of success in themselves, which take on a different form. I'm happy to touch on that briefly and then pass off to anyone else who wants to discuss. So when we're sort of tracking the impact that we're having in climate-focused investing, that's when a different set of tools are necessary to really assess the extent of the impact that's been made and forecasted, importantly, for when you're making an investment ex ante, being able to have some opinion on what type of impact is going to happen. And with that, I'll just point to Prime Coalition, which Dario mentioned as well, as a particularly leading and very public, open framework for measuring and both assessing and measuring climate impact, as some really great resources there, and an MIT startup.
Let me give this question to Jennifer as well. What are common metrics on impact and any new metrics needed? And this will be our last question.
I'll say Jesse may know this to more depth than Dario. So in the public markets, one tends to have simpler metrics in some regards. In terms of climate change, I look at dollar, so what is your greenhouse gas intensity? What are your commitments going forward? And making sure companies are not backdooring in terms of their industry associations in contesting good policies.
All right, this is the end of the hour. Thank you to all our guests, and thank you for the audience for attending. And we'll see you in the next webinar. Bye, everyone.